Good afternoon, ladies and gentlemen. It's a real pleasure to welcome you here on behalf of AIIB. I'm really looking forward to this session because you've got an excellent topic. Private capital mobilization has been discussed in almost every financial conference in the last, I'd say, few years. In fact, the first session we had today also spoke about, although it was a connectivity-related topic, we spoke about private capital mobilization because it's so fundamental to what we need to do in the field of infrastructure. I'm also very excited because we have an excellent panel of speakers and panelists because they have all tremendous track records in terms of mobilizing capital, in terms of infrastructure, and I'm really looking forward to that discussion. Before we do that, I would like to invite our Chief Investment Officer, Mr. Konstantin Limitowski, who's responsible for the public sector clients, Region 2, and project and corporate finance businesses for AIIB. So with that, Konstantin, your opening remarks.
Thank you, Najib. And indeed, that's an exciting topic and distinguished panelists, ladies and gentlemen, partners, friends, and colleagues as well. Many thanks for coming to AIIB annual meeting. I'd like to thank you very much. And I very much hope that you will find it interesting. We tried our best to select the most interesting topics for you yesterday, today, and tomorrow. And we also would be very happy to hear your perspective on those topics. Today, we are going to discuss the bridging investment gap, unlocking private capital for sustainable infrastructure. And this is the question. And the question to our distinguished panelists who are coming from a variety of backgrounds, but very active in the capital markets and in the whole business of infrastructure finance. And I'm sure you are aware that mobilizing private sector capital is one of the top thematic priorities. So we are not going to tell you the solutions. We would like to listen to you carefully so that our own records are getting better and better. And actually, we have been doing not that bad because over the 10-year period, we managed to raise from 12 to $14 billion, and depending on how you look at it, direct capital mobilization is primarily from the private sector capital, but we would like to do it better. And your insights and your perspectives are very important for us. And the challenge is huge. According to United Nations 2004 Financing for Sustainable Development report, the annual development financing gap stands at $4.2 billion. I heard a variety of numbers starting from around $1.7 to $7 billion. And I think that these are the indicators that this is the true challenging market. We cannot breach this huge gap without drawing on a variety of safe capital and primarily private sector capital, and we need to make sure that we contribute to making the infrastructure asset class as attractive as possible to attract more private capital. The joint report by MDBs and DFIs released this year revealed that the total private capital mobilization reached $220 billion this year, and these are of course, the impressive numbers, but remain far less than all those trillions which we are talking about, right? And we at AIIB recognize this challenge, and we are trying to respond with all the capacity in all our innovation. And as of May 2025, we have approved 139 non-sovereign projects, and the number for private capital mobilization I have already told you. And it accounts for 44% of all approved projects by number of projects we did, and 24% by volume. But by 2030, in accordance with our mandate, in accordance with our corporate strategy, we promise to the world that we try our best to have each year from 2030, 50% of the incremental new investments of AIIB will be 50% private, and we are working hard. We are working hard on that. In terms of the mobilization, it's around $13 to $15 billion of private capital for infrastructure development in Asia and beyond, from the bank inception to our 10th anniversary today. Whether it's big or not, it's not compared to the challenge, but it is comparable with the other IFIs. And I think that the world is calling us not only to cooperate with each other, it's no longer enough. We need to raise more financing and be creative in attracting more and more private sector capital. And we are working hard to continue growing this number through multiple avenues. And the bank business model has evolved as a result of that. In the early years, we mostly worked as co-financing partner for other MDBs, and we're now originating, leading, and structuring our own projects and attracting more private sector capital through our syndications and distribution capabilities. A notable example of that is, among the recent ones, is the Turkey Antalya Airport project, which just reached financial close. And in addition to our 140 million euro loan, we mobilized another around $80 million as a B loan from a commercial lenders. Another example is the Indonesian multifunctional satellite PPP project, very innovative projects, where AIIB anchored $150 million and uncovered of the uncovered and mobilized 150 of the financing to reduce the risk of the capital structure. One new area where we are highly focused on development of infrastructure finance is the loan securitization, and we see it as a very prospective one, and I believe we were among the first, if not the first, MDB to enter into the space, and we have undertaken multiple anchor investments across several platforms, including Bayfront Capital in Singapore and with the Hong Kong Mortgage Corporation in Hong Kong. These unique deals are stimulating the entry of institutional investors into the emerging market infrastructure. We are creating the investable instrument based on the infrastructure underlying for the international investors to be able to invest into this asset class. And there is a big interest in that. The investors cannot invest in the individual project, but the diversified pools, diversified by regions and diversified by the industry as long as it's getting greener and greener, is very much interesting for international investors. But it's not only this. The best positioned entities in each and every market are commercial banks who can generate the assets, but due to the regulations in most of the markets, they are not well positioned to do that. So they are able to originate assets, and then transform it through our platforms to the investable instrument where the international investors can do. So we are recycling the capital of the commercial banks to attract more private sector investments into the infrastructure asset class. Very, very exciting. And we are also expanding the variety of financial instruments we use. One example would be partial debt guarantee. And recently, AIIB, together with the African Development Bank, supported our dear client from North Africa, Egypt, our biggest client in North Africa, to issue its inaugural first Panda bond. And we were providing them with the guarantee. And the proceeds from this issue allowed Egypt to diversify its sources of financing, which IMF is advising not only to Egypt, many other countries, but in addition to that, proceeds would go to the sustainable green infrastructure, small-scale projects, which we cannot reach out directly. So also great solution, and since then, Najib's team and the guys are pretty busy with the more and more interest in the instrument. All of this are examples of AIIB project going beyond by working as enabler to mobilize others and widen available sources of financing. However, while we are proud of our work today, we know that we are very humble. We know that much more is needed. And there were the question which is coming to my mind is always, what more can we do and how we can improve? And for us as a young and dynamic multilateral institution, it's very important to keep asking this question. This is why today's seminar is bringing the excellent partners and interesting specialists in the market, and we'll be attentively listening to you. And I very much hope, unfortunately, I will not be able to benefit from that directly, but I promise to get your wisdom somehow differently. And we will be really excited and interested to learn from you and to apply it in our everyday reality. With that, I'd like to pass it to Najib back, and with many thanks, and thank you again for coming to us and for sharing with us your knowledge and your experience. Thank you very much.
Thank you, Konstantin, for your comments. The way we've planned this session is we have an eminent panel of 4 panelists. I'll ask them questions. And after that, we have our Chief Risk Officer, Mr. Antoine Costel, joining us as well. So we'll ask him to sum up the discussion. We'll hopefully have 10 to 15 minutes for questions from the audience, and we'll take it from there. I'll start by introducing myself, the panel session. My name is Najib Haider. I'm Director General for the Project and Corporate Finance business, which is a global business for AIIB. And I work with CIO Konstantin. And he did mention, give a few examples of transactions that we worked on. He also mentioned that we need to explore more ideas, and that's why we have this eminent panel. So hopefully we'll get some more insights in our discussion with the panel. With that, if I could request the panelists to come on stage, Manuel, Abhinav, Kaleem, Sadia, please.
Okay. Oh, got it.
So if I could request the panelists to start by briefly introducing themselves, and if I could start with you, Sadia.
Thank you, Najib, and thank you to AIIB as well to invite me today. I'm very privileged to be on this panel, and I think, as you said, the topic is extremely relevant, particularly in our uncertain environment, to work collaboratively to bridge this gap. So my name is Sadia Riki. I'm the Group CRO for Standard Chartered. Since January, I have also group management responsibilities for compliance, financial crime, legal, and company secretariat. And Standard Chartered is a large financial institution headquartered and incorporated in the UK, operating across 53 markets, primarily in Asia, Africa, and in the Middle East.
Thank you. Abhinav.
Hi, good afternoon, everyone. My name is Abhinav Sinha. I represent BII, British International Investment. I'm a member of the management committee there, and also head investments in digital infrastructure, tech, and manufacturing. BII is the world's oldest DFI, operating since 1947. We've had the pleasure of working together with you, and we would love to find more ways to work with you and others and unlock more capital. So look forward to this discussion.
Thank you. Manuel.
Good afternoon, everyone. My name is Manuel Pasco. I'm the Chief Financial Officer and Chief Risk Officer for International Container Terminal Services, Inc., or ICTSI. For those who may not be familiar with the company, we are a pure play, a dedicated port operator. Our sole business is to develop and manage ports around the world. We were founded in the Philippines, where we continue to be publicly listed. And over the past 37 years, we've grown the company to what is now a portfolio of 32 terminals, 19 countries, and 6 continents. We have a very long-term investment outlook, 20, 25 years, and in some cases, even longer than that. We focus exclusively, so all of our 32 terminals are gateway ports, whose primary function is to serve the local economy. And 18 of the 19 countries are all emerging markets. So I think all these 3 features of our business have put us in a place where we have a lot in common with AIIB. And so on behalf of ICTSI, I'd like to thank you, Najib, AIIB, and of course all of you for the opportunity to share our experiences and thoughts. Thank you.
Thank you, Manuel. Kaleem.
Thank you very much. And first and foremost, Constantine and Najib, thank you for inviting us. It's a real honor and a pleasure to be speaking to all of you on this important subject. Kaleem Rizvi, I run the regional corporate bank for Citi out of Hong Kong. Citi, for I'm sure most of you know, but for those who don't, we're sort of, I would call it the world's largest global bank, operating across 95 countries, presence countries, and almost 150 when you include the non-presence businesses, across the institutional wealth businesses across the globe, right? So thank you very much once again, Najib, and look forward to the discussion.
Thank you, Kaleem. So as I'd mentioned, we have an eminent panel. So you've now seen that we have risk managers, senior risk managers, development bankers, owners and operators of infrastructure projects, and commercial bankers. So let me start with Manuel. So Manuel, ICTSI has a strong presence across emerging markets. You've got over 30 ports. And so you have first-hand experience in mobilizing private capital. What more do you think can be done from a public-private investment perspective, regulatory perspective, to facilitate the mobilization of private capital?
Sure. Thanks for that, Najib. Look, I think when structuring these projects, there's a whole host of ingredients that need to be present for these things to work. But if I were to keep it relatively high level for the moment, I would say it's clarity of the objective of the government, of the public side of that public-private partnership. And then just as, if not more importantly, it's the execution of the process in a way that's aligned with those objectives. So perhaps I give a couple of examples to help. So even just in our industry, in the port space, it's a relatively small industry. There's relatively few of us players. But even then, there's a few quite significant, important nuances between the players. So if, for example, you have a government that is seeking to privatize its port, there should be, ideally, clarity on what is the objective of that government. If, for example, that what they want is to build scale and chase volume, as an example, then, okay, perhaps building a transshipment hub, partnering with a shipping line may be more appropriate, in which case ICTSI is possibly not the right partner for that objective. If, on the other hand, the government is more interested in operating efficiency improvements, building a port that is quote-unquote right-sized to support the needs of the local economy, and perhaps promote a healthy level of competition for its logistics and its trade, well then okay, a common user operator like ICTSI may be more appropriate. So partner selection that matches a clear stated objective, I think, is one important element of that. The other one then is the commercial terms of the concession or of the tender document. I've seen many instances where you have this classic mismatch of you're managing for A when you're hoping for B. And so giving again this example of, let's say the objective is improved efficiency and investment in the port, things of this nature, and yet when the tenders are released, the bidding variable is an upfront payment. Well, that's more of a capital raising exercise for the authority or for the government. And what it does, while as a private sector participant, I can adjust, I can respond to that. It does affect, though, how I would then allocate capital over a 20, 25-year period, or indeed even just the first 5 years. So I think, in short, I think it would be that foundationally it is clarity of objective, and then proper or the right type of concession terms that are aligned or that provide the incentive to the private partner towards that objective, and then partner selection, picking companies whose way of doing business, whose business model also aligns to that stated objective.
Thank you, Mandy. And if I may just add one more element to that is when you talk about, I agree with this sequence, but when you talk about partner selection, and so an open, transparent process, I guess, is what governments should look at to build that track record and to make that industry grow beyond one transaction.
Yes, for sure. And I think that precedent setting is important, right? Because again, these, at least in the port space, again, these things last for 20, 25 years. And it does impact other potential infrastructure projects. And so getting it right up front, I think, is crucial. To try and adjust things post the tender process is very, very tricky, and can lead to all sorts of other complications that could be detrimental to the implementation of the project.
Najib, if I may just add one thing to the point that you've just raised, right? It's absolutely critical because, especially in EM and developing economies where you need to attract capital, as governments change, as policies change, these are long gestation projects, 20, 25 years, and even longer in some cases, and therefore attracting that capital and making sure, and we've seen enough examples where policies change because a government's changed. It does give a different sort of perspective to the investors, and you want to make sure that in a world where capital moves very quickly and very frequently, you want to be as consistent as possible. And we've seen economies where this has been done well, and those have benefited, and where things have changed and moved around, you tend to lose a lot more credibility, right? So that is a critical point.
Agreed. So the next question to the two bankers. So what each market is different, but keeping emerging markets in mind, what innovative products and structures are you seeing, or do you see the need for in supporting emerging markets infrastructure? And if I could start with Abhinav, yourself, and then Karim, same question.
Yeah, look, let me take a bit of a practitioner's view on this. I think Konstantin spoke about the necessity for mobilizing, right? And I think as institutions, we need to now appreciate that no one institution can do this on their own, and therefore you need to be together and partner, right? And I think it's a very important sort of mindset shift. Now, once you have that, I think it's also then important to say, look, where are these pools of capital that you can mobilize, right? And we think of it as under four sort of big clubs, right? So the first one is people like Manuel, so corporates who understand that business can have a lot of capital, and it's a question for us saying how do we access that. Second is people like DFIs, multilaterals. These are institutions. They are impact-led institutions, so they make a very distinct view around trading off some return for impact. Right. Third are commercial institutions, people like Standard Chartered or Citi or big pension funds or insurance companies, who within a risk framework will want to invest for a certain return. Right. And then there are concessional investors. These could be philanthropies, it could be pools within DFIs and so on. Now, when one thinks of unlocking this capital, one needs to say, look, which is the most appropriate pool to tap into, right? So if it's a project with very high outsized equity return, let's say, you actually will find that the operators would be very interested, right? And what they look for to be mobilized is things like political cover, maybe an element of longer tenor, and so on. And we have examples. One of them we invested together with you, where we've gone with a large auto player, but in an EV setup. They're looking at a very large upside in the future, but what they wanted was somebody coming in for a stable period of time, which allows them to take this bet, right, and get a lot more capital. So that's really the first big way to do it, which is to say, look, if there's big equity upside, who are the right people who we can mobilize into our countries, which we tend to know better. Very relevant in digital infrastructure, where there are pools of capital with the Facebooks, the Googles of the world, and so on, right? Then really it's a lot about, look, on a risk-return framework, how do you manage that risk for the institutions? And how do you enhance the return for them, right? And that often comes down to some form of blending. It could be in the form of, taking some concessionary capital from that concessionary pool and going along with them and an institution that allows them to have credit enhancement on their specific tranche. It could be about a pooled sort of blended capital. So across a multiple set of infrastructural projects where you give either a first loss or some sort of a guarantee. So there it's a lot about horses for courses, but blending is the instrument to try and get institutional investors in. And then if I shift the focus to ourselves, I think it's quite important to harmonize what our requirements are, whether it's on the ENS side or whether it's on the sort of terms that we think are standard, because that would reduce bespoke negotiation, that would reduce the friction on the time that it takes to do some of these deals and mobilize, and it can really catalyze that capital coming in. So in summary, look to different pools of capital, think about blending quite effectively, and harmonize policies as far as possible with other investors to reduce friction.
Thank you. Kaleem?
Look, I think like just taking a step back and just sort of thinking about the subject itself, right, sustainable infrastructure. I would think about things in sort of three different buckets, right? What is your traditional infrastructure and what does that entail in terms of financing? What is transitioning financing that is coming up and coming up in a big way, certainly in parts of Asia? And there's the sort of the digital infrastructure as well, right? So those are the big components that I would just say are part of it, right? And all of those would require a significant amount of capital across both the debt and the equity capital stack, right? As commercial banks, we're obviously a big proponent of using capital markets, which is probably the deepest pool of capital available and provides the longest of tenors as well, right? So that's important. The other piece that is relevant, especially when you talk about, Najib, you talked about sort of EM sort of countries as well, right? There's a lot of conversation around how do we finance, what do we raise? The question is really as when we look at things, especially, is it a one-off project And is it of scale and size where it requires the kind of resources, and does it make a difference from a development standpoint? Because even though we are commercial, we do look at the sustainable side of it, the development side of it as well, and then what does it contribute to the economy, to the infrastructure of the country and whatnot, right? And usually we've seen successes across emerging markets, and I'm not just talking about Asia. Having sort of spent time in Africa and Latin America, I can tell you is if there's a pipeline of projects, and which goes back to the point that was being made about consistency of policies, it does help significantly commercial banks as well, right? I mean, you will call it, mini-perm structures, securitizations, things that can be done to make capital available to projects that are much more sustainable in the long run, right? So one-offs is obviously very difficult. Traditionally for those, you would have shorter tenor, sort of call it financings that are available, which are not ideal. There's a lot of project risk, as everybody knows, that's out there. And then that gets sort of taken out in sort of capital markets in different forms and instruments, right? The good part is over a period of time, we've seen capital markets, or I would call, evolve to a point where we're also actively thinking and looking at private capital itself, right? There's a large pool of capital and liquidity that is available. What it does need is an enabling environment in terms of, I would just say what Manuel was saying earlier is, does the project make sense, whether it's private or public, the sponsors, the underlying sort of needs of that project, and how sustainable that would be on a longer term basis, right? Those are critical things that you would think about as you go forward.
Thank you. I like your point about one-off versus pipeline of longer-term transactions. That's how you would create solutions. Good. Sadia, if I could come to you next. Standard Chartered has a strong footprint in emerging and some frontier markets as well. These are the markets that usually require the most in terms of infrastructure investment, but they also the markets that have complexities in terms of country risks. So when you look at these markets, how do you balance the risk-reward trade-off? How do you balance development impact and the risk that the bank is being asked to take? How do you address these?
So whenever we look at any opportunity, we assess them intrinsically first in the same way, I would say. And so projects have to meet our origination criteria, and we look at the strategic rationale of the proposal. We look at the profile, obviously the risk profile of the project, which is the nature of the funding, and as we discussed, the various pools of funding that are available, capital versus debt, the gearing, as we say, uses and sources. We look at sovereign risk, as you mentioned. With sovereign risk, not only the risk itself, but also the legal and the regulatory environment in which the transaction is going to be implemented. The quality of the underlying assets, the resilience of the cash flows running through various scenarios and stress tests, the structure of the project and the mitigation that can be provided by the structure beyond the covenant, and also we assess the various counterparts that are involved in the project. So obviously the sponsor, but not only, the various counterparts that play a pivotal role in the transactions, with a specific focus actually on contractual arrangements. So how is the EPC contract structured? What are the cost overruns and inflation mitigants, etc. But we also simultaneously analyze the impact from climate change, impact on emissions in line with our net zero strategy, as well obviously as protecting the group from possibly material reputation damage. And we do that with very much a focus on upholding responsible conduct and striving to do no significant environmental or social harm. And in fact, for Standard Chartered, sustainability is one of the core strategic focus. So obviously, when we analyze these various risks, we take a materiality risk approach, and we balance financial risks and non-financial risks. Clearly, as you mentioned, high impact value transactions are going to be assessed against this framework as well. So looking at climate risk management, and We assess that risk across our various principal risk types, meaning whether it's credit, meaning traded risk, treasury risk, non-financial risks. And this includes client-level climate risk assessment to set adequate mitigants or controls, which are very much part of our decision-making and portfolio management activities. We continuously run scenarios and stress tests to test the resilience to climate-related physical and transition risks. Second, we test the transaction against our environmental, social, and reputation risk framework. So we embed our values through position statements that are public for sensitive sectors, and we list a number of prohibited activities. But we also maintain ESG and reputational risk standards to identify, assess, and manage these risks when providing financial services to our clients. And for instance, even the highest impact transactions may bring social and reputational risks, such as land use changes, impacts on biodiversity, potential for community displacement, etc., which will be considered before making a decision. And finally, we also have net zero commitments, as I mentioned, against 12 high carbon emitting sectors, and we assess all opportunities in these sectors from a net zero commitment standpoint. So all these elements of risk management and a very thorough due diligence will form the basis for us to evaluate the opportunity, to determine as well the rating of the transaction, and that will drive the capital that we have to allocate against that opportunity. And then they're upheld through our governance, whether it's through committees or oversight forum, and it will determine as well the way we make our decision and the delegation framework. Obviously, risk return then will play a major impact into this, but we very much start by analyzing the whole remit of the risks before taking a view.
Thank you. Manuel, if I could come to you next. The investments that your company makes have a very long-term view. How do you think deals can be structured to incentivize financiers to take that long-term view? I mean, the port sector has a direct economic and social positive impact. So how do you think deals can be better structured to incentivize lenders to take that into account?
Sure. So when looking at the long-term nature of these investments, perhaps three things: two more on the equity side, and then I'll come to the financing side, or the debt capital side. The first one is, I think we can all agree that nobody really knows what's going to happen over the next 20, 25 years, right? In this day and age, we barely know what's going to happen tomorrow. Just look at the news; it changes every day. And so I think it is important that concession structures are as simple and flexible as they can be. Again, I'll give you an example where there's a tender that is being run, again, obviously in the port space, where the tender variable is a weighted average discount across all cargo types, but you only qualify if you're within X% of the average of all qualified bidders. Now, okay, we can assess that, and we can submit something, but it does run the risk that if in 5 years, 10 years, the reality on the ground changes, you're handcuffed with what is quite a cumbersome structure, because that's how you run your tender. So I think that's one. Secondly, I think there's also a recognition, even from the private sector, from the sponsor side, that there is a need, while you stay as simple and as flexible as you can be, there is equally an importance on sharing of success, right? Again, for long-term viability, there is almost no worse situation to be in than when partners or stakeholders feel like there's an unequal sharing of benefits. And so to be viable over the long term, there must be a sharing of these benefits, right? So if the business performs well, it's important that it is not just the private sector partner that benefits. No? Of course, we do need to benefit, but it cannot be just us. In my experience, there's no real need to recreate the wheel in these things, right? Among the most effective and indeed simple structures that I've seen is a simple variable concession. You pay X% of revenue, right? You align the interests with the private sector partner and with the granting authority, and everyone is interested in the success of the business, and you all share in the upside. And there are, you can do things on the margin to manage against the downside for the regulator, and that risk rightly sits with equity, and that's fine. But I don't think there's a need to overcomplicate these things, right? You just have to recognize that, again, we don't know what's going to happen in the future. Simple and flexible is good, and there needs to be an appropriate sharing of benefits. Now, from the ICTSI strategy where we are gateway terminals, it's quite clear what the link between the economic benefits and the social benefits are, right? Our business is only successful when you have healthy communities and vibrant economies, right? You need that to drive consumption, and that drives imports. To the extent there's a manufacturing element in that local economy, again, you need healthy people to work in these factories to produce the goods to export, and that's good for me at the port. So the two things in our mind go hand in hand when you're talking about economic and social development. And there are things that we have done in some of our projects to promote this. One quick example, at one of our Africa ports, we have partnered with the government in a way where we do other infrastructure developments that, yes, it benefits the ports. I'm talking about road connectivity, things of that nature. But that's also beneficial to the local community. Now, those things it's quite bespoke for this one. It does require collaboration with the government because these things are outside the concession boundary of the port, so it requires a lot of discussion. But these things can be done, right? There are precedents for them. In terms of the debt capital, unfortunately, what I've seen quite often, at least in the port sector, is concessions coming out. Sorry, let me step back. For us, it's maybe slightly different from some other sectors of infrastructure where there is market risk, right? We don't benefit from guaranteed offtakes like you do, for example, in the power sector. And while commercial banks have been able to get their heads around that, what becomes, I would assume, more difficult for them, and my colleagues will respond, is if you have to evaluate the commercial risk and you have structural deficiencies in your concession. So things like step-in rights, default and remedy, termination on default, things like of this nature that are not classically project financeable, it becomes very, very difficult. And for us as the private sector, there's already enough things to negotiate when you're trying to win a tender. If you layer on trying to fix or address some of these bankability issues, you almost negotiate yourself out of a position to win. And so it would be fantastic if someone like AIIB could play a role in deal with all those structural considerations in things like concessions, and then you leave the commercial negotiation to the open tender and things of that nature. Ideally, that does happen up front, right? Because as I said, if we were to win a tender, then try to negotiate some of these things post-tender process, it does open ourselves up to challenge from losing bidders. Say, well, that's not the concession that I bid on. And then it muddies the whole process. To the extent that we sort of miss that window and you're stuck with call it a suboptimal concession from a bankability standpoint, I will add on what my friend Abhinav said here earlier about harmonizing requirements from MDBs. What I would like to see from a sponsor standpoint is harmonization, yes, if it takes out process, but not to the point where it becomes a handcuff, right? Because if we are in a situation where there is some issues with the concession, then that's when we need people like AIIB to step in with innovative, bespoke, creative solutions to try and plug this gap, because without that, it just falls to equity, which is doable, but there are then knock-on impacts about how do I then allocate future cash flows, right? Because I would then need to consider that and be compensated for this when I have to fund a project without any debt. So it's doable, but there are there are knock-on effects. And I think this is certainly a place where, AIIB could play a very, very important role about ensuring that these projects are properly structured to be bankable, and where they're not, from no, for example, fault of the private sector participant, we find ways to plug this gap where there is still an ability for debt capital to participate, and it doesn't all fall to equity.
Thank you. I think it's extremely important points on simplicity and appropriate sharing of economics and the regulatory regime being fair at inception. So with that, I'd like to ask Abhinav and Kaleem a related question. I think Manuel has touched on some key points already, but what, from a financier perspective, development financier and a commercial bank perspective, what do you think are the bottlenecks, some key bottlenecks that are preventing institutional investors from investing in emerging markets infrastructure? What major, is it regulatory, is it geography specific? What are the issues that can be addressed to unlock some of this capital? And Kaleem, if I could start with you.
Sure. And look, I think you're right, but I would say it really depends on parts of the EM, so it's not consistent across EMs as well. As I've said, having spent time both in Africa and Latin America and now in Asia, there are different degrees of complexities that come with it. Parts of Latin America, even though very traditional EM, the local market nuances are developed and mature enough for them to understand some underlying risks better than other places. And therefore you're able to sort of create more innovative and bankable structures with a combination of what I would call traditional bank financing, commercial financing, along with sort of elements of capital markets as well, right? So there are those nuances, right? Now the key impediments, as I see it, are consistency of policies, and obviously Manuel has touched upon a bunch of things there as well. So I won't repeat those. What I had said at the very inception, Saadi had sort of gone through a fairly long list of what needs to be evaluated, right? It's a lot of resources that gets consumed whenever you're sort of thinking about any project finance deal, and these are long gestation sort of, unlike a traditional corporate finance deal where you could get it done from a couple of days to a couple of weeks. This could entail potentially a couple of years as well, right, before any institution sees any sort of returns on the other side of the spectrum. And a number of these do get abandoned every once in a while, right? So it's not 100% success rate. So resourcing is key, both and commitment, both from a sponsor perspective and from a financing perspective as well, right? You touched upon very earlier on the tendering process, right? EM, there's a lot of that as well. The good news in all of this is when you look at your traditional investors, and I'm sort of taking the main sponsor out, if you do need elements of equity and certainly debt, the markets are far more developed than they were a decade ago, right? Or even more recently. There are multiple investments and avenues available whereby you can take a debt stack and sort of split it into senior, sub equity itself, right? And therefore those options are available. The other important aspect from an EM perspective is fixed income investors generally, and I'm just sort of focusing here on the debt piece, are getting much more comfortable with parts of EM than they were before, right? The question then it becomes to the more fundamental thing that Sadia spoke about. If you check the boxes there, and it's really a function of the fact that there is enough liquidity and capital out there. There's much more capital out there that is being put to use. So if there's a bankable, viable project that makes sense, I think there's enough, at least from where we sit and what we see, there's enough liquidity and ability to do the deals and close them out.
Thank you. Abhinav?
Yeah, if I can add, I think, Kaleem, you've captured a few of the points. For me, the single biggest problem we see is just lack of investable opportunities, right? And we don't see liquidity as a constraint. I think it's just about this lack of investable opportunities. And why is there a lack of investable opportunities, even though you need this massive infrastructure, is because the lens from which we view this makes it a very you need a very high return if you factor in all the risk, right? And that makes many of the opportunities less investable. I'll give you an example. I was speaking to one of the endowments, the head of the Carnegie Mellon endowment, on how do we get him to invest in some of these emerging markets. And for him, once he adds all the risk premiums, he needs a 25% dollar return in some of the emerging markets, which is just very hard to digest. So, look, the problem is there are real risks, but if you add, in our traditional way of thinking, the sort of returns that those risks justify, you find very few investable opportunities, right? Now, how do you address it? I mean, it's not always straightforward, but there are some elements to it which can be done. I think one is an element of lack of familiarity and data gaps, which leads to, I would say, inaccurate credit assessment, maybe poor underwriting, enhanced sense of risk, even where it need not be like that. There'll be credit agency put in caps because of this lack of familiarization in some of the emerging markets. So I think that needs to be addressed. I think as MDBs, I think it's very, very important that we are involved in sourcing of these projects on the ground, because you can then shape it, and you can also shape thinking of policymakers to make these projects more investable. I think there's a third point, which again, I don't know how easy it is to solve it, but it's an illiquidity problem. There's very low secondary markets. So once you're into an infrastructure project, I mean, you're in it for at least 10 years, up to 20 years, whereas you should be able to sell it down. And there isn't that secondary market where there is capital from MDBs and so on sort of actively hesitates from entering it. So that also, I think, needs to be solved for just making sure that there are more investable opportunities. And I would say there is also a lack of equity. So again, I think both from institutions as well as the DFIs, the MDBs, we tend to be a lot more debt focused. But the real additionality is sometimes in equity. And the more we get better at providing that in conjunction sometimes with operators, I think the more the investable opportunities would get to.
Thank you, Abhinav. So, Sadia, if I could come to you with a related question, right? So, MDBs, in emerging markets, in usually credit or country risk challenging markets, MDBs do step in and take some of the risks that commercial lenders sometimes don't. What would you suggest MDBs do to enhance that partnership? Could they? What kinds of risks do you think they could take more of to be better able to support commercial banking partners?
I think, and we've touched upon a number of points already, but what we have agreed that private investment, including at scale, could be available if the risk returns, stood up, I would say, enough in comparison to other opportunities, taking into account the diversity of investment that projects could provide, and provided as well that ESG objectives are clearly met. So with that in mind, and as we said, I think we see MDBs much more than funders, but market enablers. And we've touched on a number of topics that MDB are already providing, but where probably there could be more. So we discussed, risk reduction, guarantees, and concessional finance. I think leveraging directly or indirectly their preferred creditor status, that would allow to reduce risks for investors, improve project viability, and boost the risk reward that we discussed. I think the second one we touched upon as well is this idea of pipeline building and technical assistance, because MDBs have been there before. AIIB, you do projects in 38 countries, I heard this morning. You can share that experience. You've been there, you've learned the lessons, and that's something that obviously is interesting and very useful to share with sponsors. So support early stage feasibility study, legal structuring, regulatory alignment come very handy. The third one, and maybe I'll insist on that, is the policy support and, again, engaging directly with governments to improve the framework, because the key is really to ensure the predictability and the stability of that framework if we want to invest long term. And I think MDBs can advise governments on creating clear, stable, investor-friendly policy framework. A good example of that is, for instance, sustainability taxonomies and making sure that there is an alignment across the various countries on those taxonomies. And fourth, obviously, facilitate capital mobilization through anchoring or co-investment, but it goes beyond than that, because MDBs, can inspire trust, and trust comes also not only in what you would think about the traditional credit risk, etc., but also very much in the financial crime space, creating trust in dealing, in knowing your clients, apprehending sanctions, etc. So I think we know that MDB are doing this already, and maybe more to be done. The three areas that I really wanted to focus on was maybe, the risk sharing, as we discussed, must be designed with the private sector in mind very early on. And I think that would ensure that the residual risks that matter most to commercial lenders are taken into account. Currency, for instance, the issue of convertibility of the currency, but availability of hard currencies as well. Enforceability of securities across the various markets we operate in, critical dispute resolutions, for instance, so that you don't, waste a lot of time. I think this is something that could be considered. The second one is the speed and the flexibility are critical. Infrastructure investors operate within timelines that are driven by capital markets. And so really taking transformative action on streamlining approvals, adapting to the reality of project finance life cycle will go a long way as well in unlocking private flows. And third, I was thinking that MDBs could also improve on impact transparency and data tools, and I've touched upon data in maybe another context, but clearly private investors want clear ESG metrics and impact frameworks, and I think that possibly MDBs could standardize measurement and disclosure, for instance, enhance transparency, reduce due diligence cost, maybe provide third-party certification, and maybe you do that already, and I would be happy to have your views. And fourth, I would like to insist on the fact that MDBs can be very powerful signal setters, and that, again, their involvement very often validates the credibility of a project, a government, a sponsor, and I think maybe driving more systematic forum could drive greater collaboration, again, where MDBs and private institutions could jointly assess pipelines, co-design blended instruments, exchange views of what is bankable. I think the capital is there, but we need to seize it.
Thank you very much. This is an excellent discussion, and we could keep going. I think this is a masterclass in infrastructure finance, so very, very interesting. But what I would like to do is I would like to request our Chief Risk Officer, Antoine Costel, to share his views with us as well, and then hopefully we'll have a few minutes for questions.
Yeah, okay. Shorter. Thank you very much for the panelists, excellent panelists. I will try to wrap up the discussion, not easy, to be honest. Even though we have plenty of seminars about the private capital mobilization and discussion, I would like to thank first the panelists for the pragmatic approach. This subject is a mix of idealism and pragmatism. Okay, so we need both. Actually, it's not. I don't want to oppose the two. So the discussion have clearly underscored something central, which is the sustainable infrastructure is not just a financial challenge, but something which is requiring different kind of mindset with innovative approach, collaboration, dedication of all the stakeholders, because I don't think that none of us have the solution, all the solutions. So all of us have a part of the solution to close the gap between the trillions of Constantine, okay, and the billions of Najib. We need to feel something in between. And obviously, as a chief risk officer, you are generally the bad guy in the middle. So Sadia knows exactly what it means. And we are playing with different kind of topics, which is on one side some financial analysis, and Sadia has given the list, the long list of things that we have to go through to analyze a project, and which has to be put, because we are an MDB, in front of impact, the impact it has. And frankly, as an MDB, I think we have a part of responsibility on this topic, because I have to say, and I take out my hat of CRO, when you are on one side presenting some financials figures about the risk, and you have a marketing presentation on the impact, it's easy to choose the financial approach, okay? Because as long as we are not able to quantify the impact in a harmonized way, let's put it that way, and every MDB has its own way to calculate the impact. So, it means that the CROs are going to win, okay, so on this approach. So it's something that we absolutely need to understand and to market also inside our organization. We have a unique position as an MDB to be in the middle of government and clients, commercial banks. And I completely understand the point on the taxonomy. You are talking about the taxonomy and the impact transparency, the sustainability taxonomies. We have a responsibility with our members not to be only here to make it, to finance, but also to share our experience and to advise. Advise is maybe a bit ambitious and arrogant, but to help to build the conditionalities of the bankability, because the liquidity is there. Honestly, this world is full of liquidity. So it's a complete mistake to think that the liquidity is not here. The reality is that we don't have enough bankable project. And for that, we need clients like you who are going everywhere, have the flexibility to understand what it means to evolve in emerging countries, okay, which is not always the case of all the clients, and to make sure that we can fill the gap. So I don't like generally to oppose development and return, okay, so, but it's fair to say that each of us have a different kind of objective. So I really think that the moment MDBs, and not only AIIB, but all the MDBs are going to participate to normalize somehow the way to quantify the impact, this moment will bring more certainties to the various stakeholders, and then we will be able to put in front of the financial risk, the credit risk, and etc., something which is understood by the various stakeholders, and then we will be able to finance more projects and fill the gap between Constantine and Najib. So thank you again. I think that, again, the mix is a mix, what you said is a mix of pragmatic, very concrete example, but I think we need also some idealism to work on the taxonomy and the sustainability. Thank you very much.
Thank you very much, Antoine. I don't think we treat Antoine and his team as the bad guys. I think they are our important business partners. So, and that's how we get some very innovative deals approved and done. So we're very proud of some of the transactions we've done. So we have about 10 minutes. What I would like to do is ask the audience if anyone has any questions. Please feel free to ask me or any of the panelists. I would request that when you have a question, please briefly introduce yourself and then ask your question.
Hi, hello. I'm Fabrizio Mazza from Marsh McLennan. Thanks for the panel. I thought it was quite interesting. Sadly made me realize as an insurance broker that I'm doing a terrible job because a lot of the challenges that you have described today, actually they can be partially fixed by the global credit insurance market. In fact, some of the panelists here, Standard Chartered is a huge user of these instruments, but also can obviously be applied to the equity portion of this financing. It represents a very deep, a very long-term and an anti-systemic source of unfunded risk capital. And in a lot of these transactions, although it cannot solve the entirety of the problem, it can definitely take out some of these and allow this financing to happen more regularly and to recycle the capital, both of the commercial banks, but also of the MDB, particularly the MDB, because it does create a halo effect on the transaction. So I would definitely encourage that this topic is discussed more and more in this context. Tomorrow there's a panel where I'll be speaking about this specifically, but absolutely, you know, we probably have to make a little bit more noise because that's part of the solution to the problem.
Thank you, Fabrizio. So let me just address that. It's an important aspect of the business we do. So part of our private capital mobilization strategy includes working with insurers. So and we're quite actively doing that, and I'm sure Kaleem, Manuel, Abhinav, Sadia are quite familiar with the insurance market. So thank you for highlighting that again. But agree that that's an important pool of capital that we can access. It's long-term funded, so the interests are right way aligned, and we should always keep the insurance market in mind, and we do that. Would you like to add to that?
So definitely, and we use extensively, we participate extensively in transactions covered with ECA tranches, and we use credit insurance, whether comprehensive or political insurance, as you know. And so that's a very strong instrument to be able to take a larger gross exposure because we provide the liquidity and to a good risk mitigant in terms of the credit. One of the discussion actually, and to add, across the cycles, and I've been in banking for 30 years now, primarily in emerging market, natural resources and energy to start with, and structured finance, the track record with insurance has been very strong as well whenever we had issues. Just for awareness, I would say, for a bank, when the key question that we discuss very regularly with insurance companies, whenever you have a default, the credit will be treated as an NPL, and you cannot cross-accelerate. So that's something that we discuss very openly as well, and where solutions could be found as well.
Manuel?
Yeah, if I may just give a couple of comments. So thank you for that. I think from a sponsor's perspective, and I appreciate that perhaps ICTSI has a different view on these things. Among the main reasons that we haven't used so much insurance for this type of thing, if we're talking about bankability, is when we look at it from that perspective, well, if I'm going to pay the premium versus just accept the risk, by and large, I just accept the risk. What would be great, and my friends in the commercial banks would say, well, all right, if the bank offloads the risk, well, then I'd like to see it in the premium. I haven't, and so perhaps that's a three-way discussion that can be had at the appropriate time.
Yeah, definitely.
But our risk appetite by nature is higher than the commercial banks.
Yes, Emilio, I agree with the bank. I think for the equity portion, and maybe we can take this conversation offline, there's a possibility as well to, in some of the investors' models, reduce the country risk premium on your assets by utilizing credit insurance. And as a result, your asset itself increase the net value. So is actually insurance not seen so much as a cost, but actually as an investment instrument. So it's something that we can discuss maybe at a later stage, but this is recognized by IHS as Standard & Poor's on their credit model. So it's it's something that then you can use it for an exit, for example, at some stage in the future.
Thank you. Any more questions? Yes, please.
Yeah, thank you. I'd like to say thanks to the panelists for the discussion. Very educative and thought-provoking. I'm Dennis, a PhD candidate from Tsinghua, researching special economic zones in Africa. As per the discussion, I am particularly interested in the impact of bridging the gap on sort of grassroots investment. We see especially emerging economies, young people are at the forefront of development, especially when it comes to these disruptive innovations. However, they are the most excluded when it comes to access to capital. My question is, what has been the approach of your institutions in terms of, de-risking investment for young-driven projects in your respective countries?
So who would like to, I can start by responding, but so I guess, Dennis, your question is, what is our approach to the younger entrepreneurs investing in infrastructure?
Particularly disruptive innovations that are driven by young people.
So I'll start by answering, and if the panelists would like to add. So I think the approach is, I'm not sure we need to have a different approach for disruptive technologies. We are quite actively looking at digital infrastructure. So one of our 4 thematic priorities is digitally enhanced infrastructure. But the fundamentals of infrastructure finance don't change because of that. So there are parties that are best able to bear the risks that are being asked to be taken, right? So there are people who innovate the technology. They know their technology better. Usually they're the equity sponsors, so they should take those types of risks. There are parties that should take the regulatory regime risk around that, so the government, the respective government should take that kind of risk. So there's other risks, and those parties should take those risks. So those fundamentals don't change. So if it is a new technology, if it is a new sector, usually what happens is that the equity partners end up taking more risk, at least initially, until the technology gets proven. So just because a technology is very innovative, very disruptive, doesn't mean that all of a sudden the financiers will agree to take more risk on that technology. The technology also has to prove itself economically. So as an example, when about 30 years ago solar panels were invented, banks would not fund projects with less than 50% upfront equity, and the tenors used to be in the range of 3 to 5 years, because it wasn't a proven technology. People were not really comfortable with the resource risk. They were not really comfortable with the photovoltaic cells battery life, or cells life, right? Now we see deals regularly in the 18 to 20-year tenor. We're regularly financing deals with only 20% equity because the market is more comfortable with this sector, with that technology. So I would suggest the same rules apply. And would continue to do so because the fundamentals don't change. And because people are going to take certain risks, then what Manuel said, the appropriate allocation of economics will also still apply. So if somebody comes up with a really cool disruptive technology, when they IPO it, they won't share that risk with the upside with the banks, right? So they'll make the equity upside themselves. That's usually the way things work. So it's only appropriate that the risks also be shared in that proportion. But if anybody else would like to answer that.
If I could add, adding to what you said, I mean, there are 2 other things that we see in the market. I think one is a portfolio approach, where in a specific sector, we could back a variety of companies, startups as well as potentially large companies who are going after the same asset class. Okay, so EV being one example, we made 23 investments. A couple of them are with very large operators, because they are better able to manage the regulatory risk, but 21 of them are with very small companies, with young entrepreneurs. And the idea here is to feed capital in tranches till either the minimum viable product is done or the go-to-market risk is taken up, and then sort of go up the ladder of funding. So that's one. I would say, look, the second part is also around just going deeper into the value chain. So to the example, Najib, on PVs now, there is quite a bit of certainty of the business model. But on cell manufacturing, there's less so, right? But the market is established in a way. So I think as institutions, we can take a bit more risk on it. But if I think of batteries or EV, EV is a bit more established, batteries still not so. So there's harder to take a risk. So I think the approach of institutions also varies by the sort of subsegments that entrepreneurs are addressing.
Thank you, Abhinav. So I think this gentleman had a question, so we have 44 seconds, so one more question.
Hi, thank you. So my name is Rafi. I'm working for AIIB at the SPB department. So a quick question. So we're talking about emerging markets. So for example, a country like Bangladesh or Sri Lanka, they have gone through a massive political change. And so how do we unlock private capital, or how do we find bankable projects when the macroeconomic environment is not very conducive? For example, in Bangladesh right now, the lending rates for private banks is around 14%. Inflation is high. All-time dollar is high as well. So how do you find a bankable project, or how do you unlock private capital in those type of markets? Is there any role for MDBs like AIIB can help, or maybe older MDBs like the World Bank or IFC can do? So would like to hear from all of you. Thank you.
I think we don't have, it's a very good question, and it's a comprehensive, requires a very comprehensive response, but let me just give a quick response. I think, first of all, a little bit of an advertisement for AIIB. On Monday, we approved a project which is in Bangladesh, $100 million waste to energy project. So we are taking the risks that you mentioned. But I think it has to start with what has happened on that particular project, where the sponsor is willing to step up and take most of the risks initially. And until things settle down, there may be a possibility of making it limited or completely non-recourse. So each situation is different, but those are important risks. And I think it's a complex question, but a relevant question, but it requires a more detailed discussion. And since you're a colleague, we can have that discussion later. But with that, I would like to thank everyone, the audience, for attending. Once again, I would like to thank Antoine and all the panelists for their very insightful, interesting comments. Thank you very much.